This is rare occasion because Lauren has been asked for probably 10 years to do this. This being sit with her husband and be subjected to being interviewed. And she has resoundingly every time said no.
It's true, but this is how much I love Cornell. Go Big Red.
Yeah, she loves Cornell more than me. But this is going to be all about her. So I want to start with the first question, which is this being about you. How does it feel being married to the most amazing, incredible man, greatest venture capitalist in history? What is that like?
Trying to keep up with all the humility. But what I love about our relationship is that we're very hedged as a couple, because I do public markets, value investing, and he's like moonshots, things that like may have revenue but will change the world. So it's hard to keep up with your curiosity and how much he reads. He knows everything about everything, including humility.
And we're done. It's interesting because I hope that my companies are successful, and if they are, they get acquired or they go public. But because they are often not profitable, and she is a value investor and an activist investor, I am terrified that she's going to short our companies.
I mean, obviously, I wouldn't do that.
So far hasn't. Let's talk about your career, your path. And by the way, just so people know, we actually met at Cornell, but I had no chance. Lauren only dated 6'3" jocks, and I am not a 6'3" jock. And years later,
I think the lacrosse team just won, right? There was like all my friends were on the lacrosse team, and they just had a huge season. So go Big Red lacrosse. Okay, go ahead. Sorry.
And anyway, it all worked out, and we've got 3 amazing kids, between 9 and 15 years old now, which is insane. And we've been together 21 years, and we both shared something. We both shared something when we were starting, which is neither of us came from any money. We literally had nothing. Lauren grew up in Long Island in Merrick. I grew up in Coney Island, Brooklyn. I had a single mom who was a school teacher. Lauren had a dad who worked, a mom who was a housewife, and an older brother and a younger brother. And they expected very little of her because she was the woman. And she embodies something that I love finding in entrepreneurs. And I loved hearing these entrepreneurs, which is that chips on shoulders put chips in pockets. And when people doubt you, it can often be incredible fuel to the fire. So
this interview is going great. Keep on going.
Well, you graduate high school, you get accepted to Cornell, captain of the cheerleading squad.
Oh my God, babe, you have to go there.
It's true.
No,
you go to Cornell, and what did you want to do originally?
I applied into Cornell, into the state school, thinking that I was going to do textile. Oh no, first it was psychology. So it was HDFS was the major. Then I quickly switched into textiles and apparel. I spent one summer at Chanel, and I realized this is not the lucrative career that I want, and so quickly shifted into business and finance. And I think I had a minor in communications, but one of the things that I loved about Cornell is I don't know if people are familiar with student agencies, but they're in college town. They're student-led businesses. And so I was able to take whatever I was learning in the classroom, and to the extent that I could, because a lot of it was theoretical, just apply it at the same time running. What I wound up doing as a sophomore is I consolidated like 5 promotion companies. So we did like chalking when this was a thing, right? This is before the internet, everyone. So like it was chalking. We had a Greek directory with everyone's landline phone numbers in it. We had a coupon book. When I was a senior, I was still running it, and we had something called Night Funk, which was like a web page of all the parties that were happening. But what was so cool about it was I was able to like really test like an entrepreneur, like test out different strategies and bundled pricing and things that I had learned in the classroom. And that got me super excited about business. So that really took, I think, the Cornell education to the next level for me.
You don't immediately go into the investing world. First, you go...
I know. This was like, I graduated in 2000. So 1999, all of my friends who had graduated, the women I knew who went to investment banking were like hiding under their desks and sleeping there. And that didn't seem like it was a great fit for me. And some of the most exciting like things that people were doing were in consulting around .com companies. And that's what I was super excited about. And so I wound up joining a bunch of friends who had went to a firm called Diamond Technology Partners, which was McKinsey guys, met Arthur Andersen consulting guys, and like some Harvard Business School people, and they put this consulting firm together, and the clients were, eToys and Pets.com, all the spectacular blow-ups, but also Goldman Sachs and Morgan Stanley and the Kansas City Federal Reserve. So I went out of school, I moved to Chicago, and I went to Diamond Technology Partners, and a lot of parallels to today. I joined when I signed, yes, I would join. It was like, probably end of 99 or early 2000 when the stock was like 200. And by the time I got to the job, the stock was like $2. So that was fun.
Okay, so you go from consulting and some exposure to Wall Street and Goldman Sachs, and then there's a fateful moment at a funeral.
Yes. Okay. So we're going to do the dance. We'll go for the journey. My background to being an activist investor, I run a firm today that called Impactive, which we can talk about, but it was very nonlinear. It was completely random. I was at a consulting firm. I was getting ready to go back to business school, and my best friend's father unexpectedly passed. And so I spent the week at her house at Shiva, and there was a gentleman there who was managing his own money. And I started, I was some snot-nosed, like 24-year-old questioning his technology investments. And he said, you know what, don't get your MBA, come get your Street Smarts MBA, come work for me. And so I did that I deferred business school. I went to work with him from 2003. 2004, I went back I got my executive MBA at Wharton, but I worked with him from 2003 to 2007. We took $100 million unlevered return on invested capital to $300 million. And by the time I graduated Wharton, I wanted something more institutional. I went to a firm called Blue Harbor Group, which was mostly private equity in the public markets, run by a guy who was at General Atlantic, before that KKR. And that's where I spent 10 years really pursuing the activist strategy, but more like private equity approach to public market investing.
So you become a partner, managing director there, and then one of your other partners and you are both sort of imagining what it would be like to run the firm possibly differently, and imagining having your own firm, and you decide to start Impactive. What is Impactive a neologism for? What's the symbolism of the
do you remember we were skiing, and I woke up at 2 a.m. I'm like, I found the name, because it was about impact and activism. So we'd done a lot of activism at Blue Harbor, which was mostly capital allocation ideas, strategic ideas, cap structure ideas. But we tried to really push on governance ideas and even like environmental ideas or social ideas. But at that point, people were doing it in a way that checked the box. So Impactive is really about aligning like purpose with profits, doing well by also doing good, and you don't have to sacrifice returns. So what we realized is we could build a better mousetrap, and instead of just checking the box on like de-risking something from an environmental or social perspective, you can actually drive value, right? You can create pricing power, you can reduce costs, you can reduce your overall cost of capital by pursuing environmental, social, and governance initiatives that, most importantly, they must link to economic return. So in 2017, we gave notice, and in 2018, the largest LP at that fund, Cal Stirs, put us in business. And so we've been doing that ever since.
And you had a big launch and then have gotten up to peak assets of $3 billion.
Yep.
And you don't invest like we do, where you're speculating on many, many companies. You're pretty concentrated. So for people that follow finance and follow the hedge fund world as a financial entrepreneur, what is the strategy? How do you deploy it? And then I want to talk about sort of what makes you distinct as an activist relative to like the Carl Icahns and Bill Ackmans.
Gosh, so many questions. So we run a very...
Only you were used to this.
So we run a very concentrated portfolio. We have, and at any point in time, 8 to 12 names in the portfolio, which means we have 8 to 12% of our assets. That's like, call it 200 million to 350 million or so in each investment, which makes it it makes for a very volatile experience sometimes, right? Because we're investing in companies where everything is not going so great. And then we try to work with them behind the scenes. And we're a little bit more collaborative than, when you think of an activist investor, you're thinking, Barbarians at the Gate, or you're thinking Carl Icahn. We try to work behind the scenes. We try to really influence with this substance and research and fact underpinning our ideas. And 90% of the time, it's great. We collaborate with the management team and it works out well. And, we're backing high quality businesses that might be misunderstood, where we have a number of levers that we want to work with the company on to unlock value over a 3 to 5 year period. Sometimes, there have been the rare cases, 1 or 2 times, where it doesn't go so well. And we have to use the proxy process, which is the governance levers that we have to use. And those, to be honest, we try to avoid it, because when you think about that, it takes tons of time. It takes millions of dollars to hire proxy advisors and do mailings and run a campaign. It's a very low return on aggravation, I would say, but with potential, the juice has to be worth the squeeze.
There have been these moments where Lauren would go into a boardroom with all the constructive things that she was describing, and they knew more about the company than the management did, and they owned more of the company than the management did. And then you would have this old, mostly pale male stale white board, and they would say, "Oh, that's so sweet. Thank you so much." And I would sit here having heard this, and I'd be like, "Oh God, if you would just call me and ask what is going to happen next, because it's been 21 years and I've never won an argument, you're not going to win. You're going to lose. You're going to lose your job. You're going to lose your company."
You know what it reminds me? It's that children's book where, "Oh, you shouldn't do that," where the mom chicken is walking. That is not a good idea, with the wolf, and then the wolf wound up getting canned. Yeah, that's sort of like that.
But it really is not a good idea to go up against her. And she does try to come with sort of the olive branch, but then the other side of that olive branch can get quite sharp. Can you describe 1 or 2 of these activist campaigns and what you did and how you orchestrated it, whether it was a successful sale from a public company to a private equity buyer or
Let me first talk about what we like to do, where it really works, because I think we are differentiated in our approach, right? A lot of activists will take a big stake in a company, slap a white paper on the internet, tell the management team how terrible they are and the board how terrible they are. We instead work behind the scenes. We present to the boards and CEOs of our companies. We substantiate our ideas, again, with all of our research. And then we do things like, we'll say, "Hey, we'll restrict our trading. Let us help you give your, quarterly update, or let us help you give your investor day where you're putting out the 3-year plans." Now, no other activist does that, but what that does in the mindset of a CEO, the C-suite team, even a board who knows, is that we are aligning ourselves. We're standing shoulder to shoulder alongside them, looking out in the horizon, saying, "How can we make this business worth 2x in 3 years?" And then we can add value in terms of, the market is going to take your points on this strategy for this segment, and they're going to say it's completely inconsistent with, what your earnings are doing, or your approach to capital allocation is inconsistent with the cap structure and earnings. And so when you go in, when you're basically letting yourself into someone's house, psychologically, they naturally trust you, and it allows us to pursue a lot of the activism in a more expeditious manner. That was really our approach. Now, when they lead you on, or they're being, there's a giant industry of the activist defense complex, right? Where you have advisors and bankers who charge companies massive amounts of fees by telling them, "Oh, you better beware of Impactive and all these activists. They're just here to fire you and bring you down, and they're terrible." That creates unease in a boardroom, and that's usually when things can break down. So when things do break down, I believe in transparency and trust, because eventually you're going to have to work with some people on the board. So we are very upfront. Here's what we think should be done, or we want a seat on the board. If you don't give us a seat on the board, we're going to be announcing our intention to run a slate. Here's what's going to happen. That is not fun, and it usually requires some very strong worded public letters. So we did one where we wrote a very public letter. We were right. Eventually they settle. Only 10 or 15% of these engagements actually goes to a proxy contest, a proxy fight.
And just explain what a proxy fight is for people that are not familiar.
Oh, so a proxy fight is when shareholders vote for members on the board, right? They vote for, now with universal proxy access, I'm getting into technicalities, ISS, which is a proxy advisor, or Glass Lewis, any mutual fund owner or retail shareholder or large institutional hedge fund, or even the ETFs can vote for each of the individual board members, right? And most people are on annual elections. When you access the proxy as a shareholder, because I own a lot and I've been there for a while, I can put up my own representatives to run against who the company's incumbent board. But that is like a campaign, right? So it requires a lot of money. It requires a campaign. You have to have, your points on the operational and strategic plan that you want the company to pursue that they're not pursuing, why they've tripped, footballed. And so it requires a lot, and it's also dramatic. I'm sure you've remembered, like one activist, I think, once Dan Loeb took out a Super Bowl ad against Campbell. Some people, Elliot is another one that delivered like a video home for the iconic CEO. It can get very salacious and exciting, but ultimately, what you want to do is be able to convince shareholders that change is needed. And so we did that with Envestnet. We had a big stake in this company. They did software for RIAs.
You're like wealth managers.
Correct. We wrote an aggressively worded letter, and then the company eventually we found out that the CEO lied on about his academic credentials, and that was like the smoking gun. Sadly, this is what we had to deal with. And so we didn't make it public. Most of our peers would have gone to the Wall Street Journal with that, and it would have been game over. But we decided to try to work behind the scenes. So we quickly got 3 seats on the board, and then we had to get to work. And so eventually we convinced the chairman of that company, who was in lockstep and very close with the CEO, we convinced the chairman to fire the CEO, which was very good. And then we wound up selling the company to Bain. Now, fast forward to today, that was in 2023. Today, we have one other hostile campaign going, and the chairman of that company, and we exchanged some pretty heated words publicly against one another. But he worked with us for, almost 2 years, and eventually we sold the company to Bain. And he called me and he said, "You know what, Lauren, I see you're doing this again. You voted against these board members. You're going to nominate. I want to be on your slate." And so I think that's a really, that is like the best possible outcome, because it's someone who you were once up against, saw how you work, saw the amount of effort that you put in, how you can build consensus and do shuttle diplomacy in a boardroom and unlock value, most importantly, for all shareholders. So that's where we are.
Average investment that you guys are making in terms of size, so people can appreciate?
200 to 300 million.
Okay. And when you started the firm, you have your partner. And this to me is something that's really important, thinking about partnerships. We have a partnership, but deciding somebody that you're going to be in business with. And it's important for founders who are choosing their co-founders. A lot of startups don't work out because you have weird founder DNA, weird founder dynamics. You and your co-founder are very different personalities. How did you guys figure out like your swim lanes, who was going to do what, whether or not you'd be good together in business?
I think I convinced my partner Christian to do this on our car rides home from Greenwich to New York City in like rush hour traffic. So we had like a lot of like downtime together. Yeah, we had our gripes on like what was done wrong at our prior firm and strategy. But I think you need to really like almost love and respect the person that you're partnering with. Like you really want to spend a lot of time. It's sort of a marriage. And so my business partner is sort of like a brother. And we fight and we disagree all the time. And at the end of the day, it doesn't matter because we love and respect each other. And we know we're always going to like come back together and be like, all right, now, what do we do? Usually we disagree and then we get to we take 24 hours. I take his position, he takes my position. And then we're like, all right, now what? How do you do it? You have Pete.
I have a similar partner who is actually very much like Lauren. Lauren is naturally smiley. I am resting bitch face. Normally she's in like colorful colors, like my partner Peter, who's in like pastels and
I knew you were going to be in all black, so I'm like, let's do it.
Okay, so and I'm in all black, and Zach was like, "Hey, good Halloween shoes. These are my everyday shoes," which Lauren cannot stand, and I've got like 10 pairs of them. But they're Vans with
second favorite thing about him, besides humility, are these skull band shoes.
And it's memento mori. I'm always expecting the worst in life. It's a coping mechanism from childhood stuff that if you can only be negatively surprised, you're going to not live a happy life. And if you can always expect the worst and be positively surprised, then perversely and weirdly, like I'm actually a pretty happy person because I'm just always expecting shit to go wrong. And so everybody at Lux is always indoctrinated with the idea that failure comes from a failure to imagine failure. And I'm always thinking about the worst case scenario at our companies and how do we do this. Pete is my dispositional opposite, just like Lauren is. So she's normally like positive and cheery and happy. And I'm like, we're all going to die, you know?
Thank goodness for our children, by the way.
And it's a good balance. And people
Erica will have interesting things to say about that, the clinical psychologist.
people at Lux joke that he invented the airplane and I the parachute. And it's a nice yin and yang, and it's very much the same way. But I agree with Lauren that when you have this sort of loving feeling, and I've known my partner Peter for 30 years. We met in college. He went to Syracuse. I went to Cornell through a mutual friend, and we admired each other at the time. He's very different style and personality. But I call it art, admire, respect, and trust. And it's what I feel about Lauren. It's the way I feel about my partner, Pete. Some of our best founders, you see this chemistry between people where somebody might be super technical, somebody might be the salesperson. In some situations, you get cultural breakdown where the technical person can't stand the salesperson because they think they're full of shit. And the salesperson can't stand the technical person because they're so nerdy, but they need each other. It's like a Jobs and Woz thing for Apple. And in the end, that didn't really work out. But those kinds of dynamics are really important. What about hiring your people? Would Lauren Taylor Wolfe of today hire Lauren Taylor Wolfe of yesteryear? And what do you look for?
Oh, yes, absolutely. And I'll tell you why. Sorry. I have grit. I'm not the smartest in the room ever, but I have a lot of grit and work ethic, and I will figure out how to get it done. And that is what I hire. So I hire, first and foremost, work ethic, grit, and someone who genuinely is interested in investing, and then raw intellect right behind it. But I don't care. I mean, of course I'm partial to Cornell, but I don't care about the school. I just care that you really want to work hard. You want to be part of a team. You have raw intellect and you like to invest.
Where are they typically coming from? Are they coming from other hedge funds? Are they coming from private equity or first jobs out of college?
No, not first jobs out of college. So we only hire folks with ideally 5 to 7 years of public market experience. We found that with private equity, it's a little different because at PE, kids are really trained to just think about EBITDA less CapEx and not like free cash flow, not capital deployment as much. Anyway, and understanding how the markets are a belief system, right? Public companies are priced on belief. And I think that's really hard, or it's hard to transition to that from private equity. So it's mostly public markets, other hedge funds, other activist funds, even the public people who are trading the balance sheets of Goldman and others. Where are you looking to hire from, Babe?
I actually don't care if somebody went to college. I truly want people that have chips on their shoulders, that have an ethical moral compass, because you can get people that have chips on their shoulders, but will make horrible ethical transgressions. And that ends up very poorly. But people that just have super high clock rates, everybody at Lux sort of talks really fast. They think fast. They're very competitive, but ethically competitive. But I really don't care where they went to school or if they went to school at all. Just that they're passionate about the cutting edge of tech and that they want to win. Inspirations. For me, I had a single mom school teacher. She taught special ed. I was a Westinghouse semifinalist in high school. And I did that because I saw an HBO movie. In the early 90s, there was a movie called And the Band Played On, which I doubt anybody has seen. Okay, one person, 2, 3, okay. And it's about the early days of the AIDS crisis. And there's this amazing ensemble cast and it's deeply touching. But I had the 2 important ingredients that I think are necessary for anybody that's an entrepreneur, which is ambition and total naivete. And I'm like, I'm going to go cure AIDS. And I decided that I wanted my science project to be on HIV and AIDS. And so I went around to all these labs. Nobody would take me. I found this one guy. I was 13 years old. Finally, I wouldn't relent and I wouldn't take no for an answer. And he led me into the lab. And it changed my life, not because of the science that I would publish and do, but because he was trading futures and options and stocks while we're waiting for a centrifuge of blood to spin down. And I didn't know anything about markets. And that was like an amazing first thing. By the way, similar to your .com thing, all my bar mitzvah money, which was like $6,000 or something, I put into iOmega. Does anybody remember iOmega zip drives? The same people that saw the HBO movie with me. It went my $6,000 turned into like 20, and I'm like, I am rich. This is amazing. And it promptly was a fraud and went to zero. Yeah. And it's a very valuable lesson to learn early on. Anyway, that was my inspiration, was a science mentor who was trading futures and stocks and options. And I got enamored because I didn't have any money and I wanted to make money. And then, by the way, when I went to Cornell, I really resented the rich kids that I was in class with. I was very jealous of them and very envious of them. And I thought that I was smarter than them, and I was just born in different circumstances, and that was my motivator. What inspired you? Your mom didn't work. She wasn't in finance. Your dad worked at Con Ed.
I feel like a shrink should do. I mean, I feel like
What?
No, honestly, do you remember fine, since you did a movie, do you remember the movie Working Girl? Melanie Griffith and her pantsuit? Oh man. I was
Pantsuit.
like, I'm going to be, it may have been like a skirt suit, but I was like, I'm going to be Melanie Griffith. I'm going to be Working Girl. And I'm either going to be CEO of something, or I was just always interested in business. And I did like a stock picking where I grew up. The parents were either stockbrokers or mafia. And so those were my options.
They might have been the same. They might have been.
I mean, if we're being honest. And so I was like, oh, the stockbroker dads are like, that looks pretty like a good gig. And so I started like getting interested in the stock market and in business. I was president of a thing called DECA, which is like a business undergrad thing for public schools. It was awesome experience. I loved it. But I want, my parents were very traditional with my mother as a stay-at-home mom, and she relied on my father for money, and that created a very interesting power dynamic to observe as the only daughter in a family structure. And I said, and I teach my daughters this now, like, being smart about money, being smart about your finances is freedom, because you will never have to rely on anyone for it. So I always knew that I was going to be extremely self-sufficient.
Talk about women's issues, because you have, for our family, it's probably one of the most important things that we spend time and money on under your leadership of this. But talk about Center for Reproductive Rights and where you spend our time and money.
Tim is in the audience here somewhere, also Cornell. No, I care deeply about women's rights, and huge fan of Ruth Bader Ginsburg, who was also a Cornell graduate and an AFI, member, as was I, just if anyone's counting. But when Roe v. Wade was overturned with the Dobbs decision, I think for many women in America, it was, and maybe not a generation above us, because your mom was not surprised by it at all. She had been like, there are warning signs. But, it really pulled the rug out from under us. And so I think for me, when you take away a woman's right to make her own healthcare decisions or bodily choices, you are effectively diminishing women's status in society, period, point blank. And so I think it's incumbent upon all of us, not only women, men, right, who want a society where everyone who's born into society is really wanted, and where women don't feel like they have to hide from things. Or anyway, so I got involved with the Center for Reproductive Rights. I care deeply about what they do. They provide legal representation to women and doctors on a state-by-state basis. So right now, they represented Amanda Zaromsky. Right now, we're representing a number of doctors that are getting sued. Like Texas is suing a number of doctors in Colorado who provided abortion care, which is fully legal in the state of Colorado, but Texas is trying to go after them for murder. This is scary stuff happening in society. And so the Center for Reproductive Rights is sort of the sister to Planned Parenthood, in that they are providing the legal support to protect, women and doctors, to allow them to make their own body choices.
Lauren has been an amazing role model, not only for our kids, our son as well, but also for young women that want to go into finance. And she's been on the stage of Robinhood with all these masters of the universe and hedge funds, and she's given speeches. And she uses part of the platform when she's done giving an amazing stock pick to basically say, like, men have to get off the sidelines and get involved. And it's a different form of activism, but it's a super pro-social one. Other inspirations, books that you would recommend that everybody would be foolhardy to not read?
Well, if you're interested in investing, I know you guys are entrepreneurs. Actually, one that's good for entrepreneurs and investors is The Outsiders by Bill Thorndike. And then
what's that about?
The Outsiders is about capital cities, like very smart CEOs that made the long-term decision, right? That played for the long run, that made smart capital allocation decisions, didn't go for the sugar highs, but like made the right choices, and then built tremendous value for themselves and their shareholders. But I think it's like mandatory reading for anyone who wants to go into business. The Intelligent Investor, if you want to be an investor, is just, I think, the best book, hands down. And then Bad Blood, whoever mentioned it, one of the judges. I mean, then there's like the fun, salacious ones. So like, Bad Blood or Shoe Dog, like all the exciting stories.
There was a fiction book that you and another Cornell best friend of yours were reading, and it had some Cornell protagonists.
Oh, The Latecomer was really good. It was, I don't know, that's right. The Latecomer was written by Jenny, I forget her last name, but it was about triplets who were raised in Brooklyn and had the traditional like New York life. And then the kids wind up going, or 2 out of the 3 kids wind up going to Cornell. And so, but it was great. I think it was really well written.
I think we probably have
Yeah. Questions.
time for questions. You can ask anything. We're
And ask Josh.
no stupid questions, but we'll happily answer anything.
Don't be shy.
This might be like naive, but you said no stupid questions. So I was wondering, kind of for either of you, what was that process like to like start a VC firm? Like, how do you go about it? Like, how did you guys personally go about it? What was your like first investments, and how did you kind of articulate that in your mind before you really like executed?
So I started much younger, like a year out of school. And your first investor was how big? 250, 300 million?
250 million.
Mine was like 50K. But when we started, it was premised on this hypothesis that there's nothing new, just history you don't know. In the history of venture capital, every 10 or 15 years, there's some secular wave in technology. In the 70s was personal computers. In the 80s was biotech. In the 90s, it was TMT.com, fiber optics, optical networking. And the idea was that the next wave was going to be the physical and material sciences. That was our speculation. And it was in part because I saw brilliant people at Cornell, like this guy, Harold Craighead, who ended up going on doing this interesting company where he was using semiconductor patterning techniques to unfurl the natural entropy of a DNA strand to be able to sequence it in a linear way. And nobody was up at Cornell really thinking about how do you spin these technologies out and how do you finance them and fund them. Everybody was around MIT and Harvard and Cambridge and Route 28 and Silicon Valley. And so we said, let's go after these brilliant professors that were at Cornell, Georgia Tech, UT Austin, Michigan, where there wasn't a big venture presence. And then we went out to raise friends and family money. And I always joke that we had friends and we had family, and none of them had any money. And we got lucky. And a guy so I graduated Cornell in 99. I went into investment banking because I had read Liar's Poker and I had seen these, and that's where you go to make money. And I hated it. And I was so smart that I wasn't smart enough to collect my first year bonus. I left 9 months after and decided I had nothing to lose. I literally had no money. And the money that I did have in the ensuing 3 years, I spent all of it on her ring. And she literally...
And I only learned it after we were engaged and living together, and I had
So we're like 24, 5, 6, 7. And she's like, all right, so let's go over our finances. And I'm like, okay. And she's like, so like bank account, I'm like, got nothing. She's like, wait, what? And debt, I'm like, got a lot of it. And she's like, I need to go for a walk. And
It's a 5-hour walk, and I
she's
came
like,
back with a plan.
what's our 5-year plan? And to this day, I have the spreadsheet actually of our 5-year plan, but I'm like, it's still all going to work out, and we're very different like that. Anyway, so I try to find friends and family money where we go around to people. And a guy in my investment banking group had a father that worked at a company called TRW. And that had gotten acquired by Carlyle, or a division of it had gotten by, and he said, you should meet this guy, Bill Conway, who is at the Carlyle Group. The Carlyle Group maybe had $6 billion under management in 2000 or thereabouts. And today it's $500 billion. And I go to DC to meet this guy, Bill Conway. And he is a deeply religious guy, Catholic mass every morning. I'm not, I'm the antithesis of that. And I get an audience with him, and I don't know the circumstances of that morning, but I always am intellectually honest and humble. It could have been a totally different counterfactual. He could have been in a bad mood. He could have gotten in a fight with his wife. He could have just found out they lost a limited partner or they lost money on a deal, but he was in a great mood. And he literally said, I hope you make $1 billion. And he became an investor in our management company, would go on to sponsor our first fund, because we had the paradox. How do you raise a fund without a track record? How do you get a track record when you have no fund? And so we would just bring him deals. We had an 80-20 split, no management fee. And we would do those deals, and we started doing deals, getting in the game, small checks, $250K, $1 million here and there. And that was what we called Lux One. And nobody wanted to invest in a first-time fund. So when we raised our first fund, we called it Lux Two. And this is interesting because I had a $100 million target for Lux Two. And it took me 2 years, and I had Bill Conway and Pete Peterson, who founded Blackstone, and Stan Druckenmiller, and Ken Griffin, who we saw last night for dinner, founder of Citadel, and all these amazing people. And I couldn't close $100 million. I got 92.1. And to this day, I remember every single person that said yes or no. And today, I don't forget that. We are about to close a $1.5 billion fund, and I have over $1 billion of excess demand, and it's insane. And I still remember the people that said yes or no to me 20-something years ago.
I said yes for the record.
So in this day and age, we got a lot more companies staying private longer, right? So venture-backed private longer. Yet there's the efficiency, kind of capital efficiency argument about public markets and the activist space. So how do we square the circle then of all of these companies staying private and then not giving activists access to do their activism to make them better?
Great question. I mean, there's so many different ways to go there. So first, there's been an issue in the public markets where actually the supply, there's been so much demand and capital that's flown to the public markets, and the supply of stocks is actually down over the past 5, 10, 20 years, any time period. So it is a problem that private companies are staying private longer. And the challenge really is that private investors are willing to assign significantly higher multiples than the public market, right? And so and there's so much capital in the private markets, like growth capital, that's been raised, especially over the past couple of years when money was free, that they had to compete to get in the deal. So they're bidding these assets up. And in addition to bidding the assets up, they want to be buddy-buddy with the CEO. So they're saying, here's super voting rights, right? That type of structure is really difficult when it comes to the public markets, because public market investors, want to hold management teams accountable. They want good governance. And so that has been really tricky. Now, some of these like dual share classes and super voting rights will sunset over time. But I think the real problem is that there was so much capital in the private markets bidding up assets that the most recent rounds would have to take a down round to go public. Unless you're like an AI and have no revenues whatsoever, nuclear thing, and then, you can go public at like 20 billion, no problem. But we wouldn't own that anyway.
Yeah, there's a growing, robust secondary market that exists in a way today that it didn't even 5 or 10 years ago. But I do think some of the best companies can afford to stay private because the demand is so high. You have some of the public market funds like the T. Rowe's, Fidelity's, Morgan Stanley's that are doing crossover investments, and they're comfortable side pocketing that because they position it as we're going to have early access to the IPO if and when they go public. You have people like Stripe that may never go public, and you have people like Anduril, where we were founding investors that will go public eventually. And the demand, I think, for some of those top companies are high. You have another weird dynamic in the venture world right now that not a lot of people are clued into, which is instead of, we basically make money by either taking a company public or selling it. And the best way we can sell it is when there's an oligopolistic industry structure. There's 3 or 4 people that will irrationally compete for the company, and they'll pay a higher price. But you have this weird dynamic right now where instead of M&A, you have L&A, license and acquihire. And part of that was because of a relatively oppressive regime from DOJ and FTC. People anticipated that would lighten a lot more under the next Trump administration, and it still sort of exists. But the arbitrage, the regulatory arbitrage that some of the large players, particularly Meta, have deployed or employed, they'll buy 49% of the company, they'll pay out some of the investors, they'll keep this shell. It's just like there's a lot of games being played, and I can tell you that we as a firm, as we're thinking about new investments, are now thinking about what legal terms do we have to put in to, in that eventuality, prevent key man from going and getting this crazy green mail package deal that benefits him or her and screws the investors. And so sort of like the idea of a Chesterton fence, when it's there, it was there for a reason, and almost every legal term is there because somebody got screwed in the past. So you're going to see a lot of new legal terms for that dynamic as well.
One more question.
Hi, thank you so much. That was very insightful. And I was wondering more on the impact part of your company. So do you use, and if so, what impact management and measurement systems for your investments? Really curious about that, considering all the trends sort of that is spiraling around it right now, like such as IRIS and others.
Yeah, good question. We started using the SASB materiality map. Again, because our North Star was, we're not going to do environmental, social, governance change or sustainability initiatives for the sake of doing them, right? We want to do it only if it helps a company become more profitable and more valuable. And so a number of the organizations consolidated, so there's IISB internationally, and we'll look at that for guidance, but we're not suggesting like 7 or 8 things to a company. We're generally cognizant of where there's risk and vulnerability, but when we go to a company, we'll say, hey, you should invest more in this blue ammonia project, right? Because one, it lowers your cost of capital and it's going to accelerate your growth, right? And then we do the numbers. Or you should invest in this EV transition plan, right? And it's really, we'll look at the materiality map, we'll look at IISB, but for the most part, we have like one key idea where we have a high degree of conviction in the IRR, or the rate of, like the returns based on a limited investment the company can make today, and we pursue that. In terms of guidance, I would say I think it's going to be the IISB and like CDP that are the ones that eventually are the most important frameworks.
Can you share the automotive story with the mechanics?
Oh yeah. So this is an example of like, it's very hard to prove, and McKinsey and Stanford and other business schools have tried to prove how diversity initiatives can drive economic return. But here was one where we thought it was really good. So we were the largest shareholder of an auto dealer. It was, when we bought it, it was the 8th or 9th largest auto dealer in the US. Today it's the 4th largest auto dealer. And the auto dealers are amazing businesses. Their ROICs are like 28% through the cycle. It's incredible. And most of their, about 70% of their profits come from parts and services. So it's not, they're not making profit when you buy the car. It's when you bring it back for servicing that they make a substantial amount of their margin. And so the challenge is that throughout the industry and throughout the US, the parts and services bays where they hoist up those cars are only 50% utilized. And it's not because of the bays themselves, it's actually a labor issue. So we have mechanics in the US retiring at a much faster clip than you can attract new talent to the space. And when you peel back the onion, and we looked at the Bureau of Labor statistics, when you peel back the onion, it's really, they were overlooking one candidate pool entirely, and that was women, right? Women represent $200 or $300 billion of auto sales annually, but they represent less than 2% of mechanics. And it's not because they're not interested in it, just because they hadn't been like exposed to it. So we work with this company to attract and retain more female mechanics, to educate them. And especially as cars become more silicon than steel, right? You can diagnose the issues on like an iPad. That lends itself to more like skilled work. You're not like hoisting up giant cars and bays. That they've, Asbury, the way that we rationalize this to them, we said, listen, your parts and services segment is worth 5x the rest of these other segments because it's the most profitable. So if you can, if you take your utilization from 50% up 10% to 55%, that's going to drive 20% to your overall enterprise value because you're going to grow parts and services that much faster. And so that's how we convince them to invest in. They're the first publicly listed auto dealer to offer paid maternity leave. They do 2 shifts during the day, do a lot for childcare and health and elder care. They have a 4-day work shift if you want. And so they were really innovators and pioneers and thinking through that. And it's helped because, right, it's impacted the bottom line. And they tripled, they're only at like, they're at like 4% of their mechanics staff are women, but I think that's on the way to 15 and 20. And the more women see other women doing these things and they can make, over $100,000, I think you'll attract more and more talent to the space. And that's the type of
last question from me, if I may, and just to sort of end on a serious note so that everybody here can sort of learn from you. What is your favorite thing about me? No. What
Again, it's the humility that just rises to the top.
What is your favorite thing about being an entrepreneur, about running a business?
It's really nice to have done it. It's really nice to prove to yourself, oh, I did that. Like I knew I could do it. I wanted to do it. And it's really just reflecting on it. I still think I'm going and I have so much to prove. But when you're at the end of the day, it's really, rewarding to introspect on some of the things that you were able to achieve.
My much better half, Lauren Wolfe.
Thank you.